The live trading price for Novo Nordisk A/ticker symbol NVO currently sits at $47.78, reflecting a notable decline in intraday trading, dropping approximately 1.35% from the previous close. This single-day movement cuts against the long-term narrative that has made Novo Nordisk one of the most talked-about names in healthcare, a stock where the expectation is almost always unbridled growth, fueled by their dominance in the GLP-1 drug market. But right now, the reality of the market is far more nuanced, and this small but significant intraday dip on the heels of their recent earnings report highlights a deeply unanticipated pressure point. The company's raised guidance is being overshadowed not by a sales slowdown, but by a substantial increase in their acquisition offer for Mounjaro Inc., an obesity-focused biotech. This aggressive bidding war, intensifying against Pfizer, signals a willingness to spend big to secure future pipeline growth, essentially trading near-term profit certainty for long-term control over the next generation of weight loss compounds. That's the real story today, not just the earnings miss on a consensus estimate. It's the sudden, dramatic shift in capital allocation strategy that is giving investors pause. The general expectation surrounding Novo Nordisk is straightforward. They are a powerhouse in diabetes and now obesity care, with the blockbuster drugs Ozempic and Wegovy acting as perpetual growth engines. The public narrative is one of capacity constraints being the only bottleneck to astronomical sales, meaning every quarterly report should be a victory lap. Retail investors, many of whom are getting their first taste of individual brokerage accounts through platforms like Robinhood or engaging in self-investing through options on interactive brokers, have flocked to the name, viewing it as a relatively safe, high-growth healthcare play. However, the reality we are seeing post-earnings is one of intense competition and looming regulatory scrutiny in the U.S. Their quarterly earnings actually missed the Zacks consensus estimate for EPS, and the accompanying news involved the company agreeing to the U.S. Inflation Reduction Act's negotiated maximum fair prices for their key GLP-1 drugs for Medicare coverage. While securing the Medicare market is crucial for volume, the agreement on price floors and the constant threat of drug pricing legislation introduce an unanticipated element of risk and margin pressure that runs directly counter to the unlimited profit expectation. We are seeing a clear reaction in the daily swing volume, which is notably higher than the average, indicating a scramble between institutional selling and retail buying the dip. The institutional activity over the past few days has been a mixed bag, with some major funds trimming positions after the Q2 report, anticipating a slower GLP-1 growth trajectory, while others, perhaps seeing value in the lower price, have been adding. The data shows a higher number of decreased institutional positions than increased ones in the last reported quarter, yet some recent filings show key institutional players like Truist Financial Corporation significantly increasing their holdings, suggesting a deep internal disagreement on the stock's intrinsic value at this juncture. This battle between professional managers and the broader market's growth expectations is what is driving the volatility. Macroeconomic pressures, particularly the rising cost of large-scale clinical trials and the sheer capital needed for production expansion, which they had forecasted at a significant DKK 45 billion for capacity build-out, further compound the margin story. The market is not just processing quarterly figures, it's weighing the cost of maintaining market dominance. When you consider the competition from Eli Lilly, whose own weight loss drug is gaining traction, the simplistic expectation of unconstrained growth for Novo Nordisk gets challenged by a much more expensive, high-stakes reality. The core of Novo Nordisk's business, which some may overlook when focusing only on the latest obesity treatments, has been a century-long dedication to diabetes care. They operate through two primary segments: diabetes and obesity care, and biopharmaceuticals. The former is obviously the current growth engine, encompassing insulins, GLP-1 compounds like semaglutide or Ozempic and Wegovy, and various protein-related products. The biopharmaceutical segment focuses on severe chronic conditions, including hemophilia care and growth hormone therapy. This stable, diverse foundation is often forgotten amidst the hype around the latest obesity treatments, but it provides a critical baseline of cash flow and stability, differentiating them from pure-play biotech firms. Historically, Novo Nordisk has consistently delivered solid financial performance, evidenced by a historical earnings growth of over 22% per year over the past 5 years. Even their latest quarter, while missing consensus EPS, still showed a solid 5% year-over-year revenue increase. Their long-term strategy, laid out in previous investor highlights, aims to secure over 1/3 of the global value market share in diabetes and achieve over DKK 25 billion in obesity sales by the end of 2025. This focus on global market share, and specifically transforming 70% of their U.S. sales, underscores a methodical approach that contrasts sharply with the day-to-day stock price hysteria. For those who invest online, perhaps through a Schwab Intelligent Portfolio or managing a Fidelity account, it's this underlying quiet execution that provides the long-term anchor. Looking ahead, the future outlook for NVO is a study in conflicting forces. On the expectation side, the continued strong demand for their GLP-1 drugs is undeniable. The massive market for obesity and related cardiometabolic conditions suggests a multi-decade growth runway. We are still in the early innings of this pharmaceutical shift. The potential FDA approval of an oral semaglutide for obesity, a milestone the market has largely priced in, but which remains a significant catalyst, would massively simplify patient access and further extend their lead in the oral treatment space. However, the reality of the risks is becoming clearer. The bidding war for Metsera is costly, a necessary evil to bolster their pipeline against competitors, but it drains capital that could otherwise be returned to shareholders or used to lower their debt load. Furthermore, the political pressure in the U.S. regarding drug pricing, coupled with the Inflation Reduction Act, means that future margin growth, particularly in their most profitable market, will be capped or at least heavily scrutinized. This is where active investors using platforms like SoFi Invest or those receiving investment help from a financial advisor need to weigh the long-term thematic growth against immediate financial constraints. The company's increased R&D spend and manufacturing expansion are vital, but they depress near-term profitability, creating a valley of earnings where the stock could struggle for a period. Yet the price-to-earnings ratio is currently trading significantly below its 5-year average, a statistic that contrarian investors and value-oriented Fidelity Investments clients will find highly attractive. This PE compression suggests the market is already pricing in a significant slowdown in profit growth, meaning the reality of the stock's valuation may be far cheaper than the current growth narrative suggests. The expectation versus reality dynamic for Novo Nordisk is currently settled on a high-stakes question. Can the company successfully transition from being a growth stock primarily fueled by volume and pricing power to a high-volume, integrated chronic disease management company that accepts some margin compression in exchange for market entrenchment and future pipeline security? The market sees the expense. The long-term investor should see the security it buys. The dip today at $47.78 summarizes the tension between the immediate pain of a reduced near-term forecast and the calculated massive spending aimed at creating an even more impenetrable moat for their future profits. Comment below how many shares of Novo Nordisk AS/you currently hold, and what price target you are looking for over the next 18 months. The current reality is that Novo Nordisk is undergoing an expensive but necessary transformation to secure its market leadership for the next decade. The expectation of flawless, margin-expanding growth has been replaced by the more difficult but potentially more rewarding reality of a company aggressively defending and expanding its territory against a formidable rival while navigating a complex regulatory landscape. This isn't a company's core product thesis is broken. It's a company paying a premium for a pipeline that keeps the growth story alive long after the first-generation GLP-1 drugs have matured. The market sees the expense. The long-term investor should see the security it